SIP contributions today do more in a month than they did in the entire of 2014. Markets are near all-time highs. But does that mean that your generic or ELSS or index funds are the best bet? Or are there better investment options available in the market? Welcome to TOI Wallet Talks, as we talk to Chethan Shenoy of Anand Rathi Wealth, and he tells us how and when can investors opt for multi-asset, multi-cap, flexi funds, or international funds and others to improve the quality of their portfolio. Welcome to the show, Chethan. So, Chethan, multi-asset funds are actually a very talked about category of investment these days. So could you tell us a little more about them?
Yeah, multi-asset funds, like the name suggests, is something that allows access into multiple assets. There's equity, which is obvious. There is debt. There is gold that a person can get access to. There's also a little bit of silver and REIT, which is real estate funds, that a fund manager can take exposure into in a multi-asset fund. So, given the kind of assets that a person can get access to are so many, and then you allow the fund manager to take a call on how much allocation in which fund he or she wants to allocate into. It's definitely something that looks very attractive for investors. There is an option of aggressive options, which is higher return but higher risk, to the other end of the spectrum, which is conservative. Naturally, the aggressive one will end up having more equity exposure and needs to have a longer term high time horizon for investment. And the conservative one will have lesser equity exposure and shorter time horizon can be considered for investing. So the track record at this point in time, it's fairly new. In the aggressive space has been pretty much okay, no problem at all. So, but then directionally, I think it's a very early stage right now to talk about past returns and track record as far as multi-asset funds are concerned. But I think to conclude, I will just say that it's easier for a beginner or somebody who's just starting off to rely upon somebody else's expertise when it comes to asset allocation. And for those kind of investors who do not have their own expertise or understanding of finance, to rely upon an expert for their opinion and allocation into multiple asset classes. For them, this would be a good choice.
Okay, but what about flexicap funds? What are the advantages of taking that route?
So flexicap fund, on the other hand, is equity, a pure equity. It is only one asset class that they allocate into, which is equity as an asset class. Naturally, that means that you have to be careful to make sure that you are allocating long-term money into it, 3-year, 5-year, possible really long-term 7-year plus monies into it. The good thing about flexicap is if you look at the different categories, SEBI categories, of funds that are available to you. There is large cap, there's mid cap, there's flexi cap, there's multi cap. Flexi cap as a category has fared very, very well compared to other categories, especially compared to a large cap category. And this happens because the fund manager has the flexibility to choose between large cap, mid cap, small cap basis the fund manager's views on which is going to do better over the other. 5-6 months time, you've seen that small caps have done very, very well. So a fund manager who had a view which was that small caps will do better than large cap, in a flexi cap has the flexibility to increase his small cap allocation, reduce his large cap allocation, and that will show up in the NAV and the performance of the fund. That's the advantage one has in flexi cap, and it has done very well. Compared to large cap, it's done much better.
Okay, but recently the pharma index actually hit a new high. So do sector funds in that sense help bring a more focused approach towards investing, and do they actually therefore end up bringing better returns for investors?
The answer is definitely that theoretically, yes. Theoretically, if somebody can get sector calls right, you look at which sector is done well at which point in time, you'll say, okay, I can move from sector A to sector B. If I have to name the sectors, move from automobile sector to IT to pharma year on year. And if I keep switching and becoming overweight on these sectors, I should have made better returns. But practically what happens more often than not, Smriti, is that we all fall prey to the problem of our bias towards past performance. Now, when a sector is not done well in the past, is actually a great time to enter into that sector. But then nobody wants to touch it at that point in time. And when a sector is done very well, probably is not a great time to enter, but everybody wants to allocate money into it. So we all are biased towards allocating money towards something that has done well in the past. And that is something that I'm very worried about for investors who are trying to take sector calls. It is, of course, a true story for even diversified funds, but more so for sector funds. So it's very important to get your sector calls entry right as well as exit right. As an investor who has to be careful enough to enter at the right time, exit at the right time, I would rather say rely upon the expertise of the fund manager in a flexicap fund kind of a fund, where the fund manager will anyways take a call of being overweight or underweight on a sector basis his analysis, and he's definitely in a much better position than us to take calls on which sector should he go overweight, which sector should he go underweight.
But when it comes to multi-caps, do you think that multi-cap funds actually help provide a more balanced approach towards investing?
Just to for the audience's sake, multi-cap is also a 100% equity fund. Point number one. Point number two is multi-cap has a compulsory 25-25-25 allocation. 25 in large cap and mid cap and small cap. 25% each has to be there. Now, beyond that, there is flexibility. But the first 25 is compulsory, and that's going to be monitored, and that's what the SEBI regulation requires you to do. Now, going by the past performance of multi-cap, the performance has been pretty good, I should accept. Like I was telling you, FlexiCap has been able to beat large cap. So I'm better off in FlexiCap fund than in large cap funds because there is flexibility. In multi-cap category also, if you look at it historically as a category, multi-cap is done better than large cap as a category. Now, coming to the point on between multi-cap and flexi-cap, at the face of it, I would say we are better off with flexi-cap because the fund manager has the flexibility of going anything, right? Like he can go to less than 25 in small cap if he feels it's extremely expensive. But if you look at in actual, multi-cap has given tough competition to flexi-cap and has done pretty well. And that may be because small cap in the long term, and I'm talking about 3 to 5 year time horizon, has always beaten large cap, but it has a tendency to be very, very volatile in the short term. So holding on to a fund which has higher small cap allocation is not an easy thing for all of us to stomach. So just walk in with the understanding that multi-cap could be a little more volatile, risky than flexi-cap, but historically, because it has a compulsory 25% to small cap, has done better than flexi-cap in the long term.
And finally, Chethan, if I want to invest internationally, so what can you tell us about international funds?
I will say that yes, there are funds that are available. You have Nasdaq ETF. You have some of the funds which have opened up. As you're aware, it had shut allocation towards international because there is a limitation that has been put in by RBI because it's after all international. The money is going out of India. But there are a lot of feeder funds that are available to invest into international, whether it is US or China or emerging, or there are multiple geography-oriented funds which give you exposure to diversify outside of India. Once again, theoretically, looks great that you're going to get exposure outside of India. You may want to take access to companies like Apple and Microsoft and Alphabet, etc. But at the face of it, I would say that just be careful to understand two things. Point number one is your taxation is going to be higher. Now, international funds have a taxation which, especially given the new tax regime which got introduced, it's going to be taxed at marginal rate of taxation. Now, if a person has an income above a certain amount, we all know we get into a 30% plus education cess plus, etc., etc. We'll end up paying that kind of a tax. Unlike equity, where it is 10% plus cess, right? So it's substantially 20% substantial difference, right? So the international fund better have the capacity to deliver you that kind of extra return. Otherwise, why will I take exposure into international funds? Point number one. Point number two, while theoretically it looks good in terms of taking exposure, etc., there again the problem and the tendency is to bypass performance. Like we all know that US did extremely well, the US markets did extremely well, and everybody flocked into buying, international funds, especially US funds, at a point in time when the past performance was very, very attractive. But ideally, you should have been investing when the past performance was not really good, because mean reversion is the reality of life. When something is not doing well, the next 3 years, 5 years, the likelihood that it will catch up and do well increases. compared to something has done really well, and extrapolating it would be very risky. So I would say be careful to understand that past performance is not an indicator of the future. So there should be study and understanding of what are the price to earning multiple, what are the earnings of these markets that you're investing into, what is the inflation of that country, and what are the central banks saying. If you've not studied all this and you've simply allocated money, A, the tax implication is high, and B, you may have to wait much longer than in Indian equity to generate the kind of returns that beat Indian equity. So I will, for the time being, stay in India and not go into international equity.